We have an amazing panel. We're going to be talking about a lot of good stuff and obviously focused on fundraising. Hopefully that's why everyone's here for. And I'll have the panel obviously introduce themselves, although they don't need introductions, but always good to kick off. Excellent. So with that, I'd like to start with Andy, and we can go down the line.
Sure. Thanks, Anil. First of all, let me thank Anil and Ventus, and of course Tycon for putting this workshop together, and very pleased to be partnering with Anil on it again. So Andy Tsao, longtime Silicon Valley Bank SVBer, shall we say, and been there for a couple of decades, so certainly well before the events of a couple of years ago. But let me first just say that SVB is back, under new ownership, of course, with First Citizens Bank, but doing all the same things that we've done in the past to support the global innovation economy. And of course, the cross-border India is something that we care quite a bit about on my team that focuses on working with international firms. And so whether it's startups, scale-ups, venture capital firms, we've been active in India since 2003. So it's been quite a number of years. So commercial over, and we'll get into the fundraising discussion. In addition to the equity component, I'd just say that my perspective outside of working alongside many of my friends here for many years, my expertise will fall on the credit side. So when you think of an alternative source of financing for your business from equity would be things like venture debt, and would be happy to share a perspective there.
Thank you, Andy. I'll maybe use the speaker. Hey, everyone. Welcome to the Fundraising Lounge. We were kind of discussing what we were expecting in the lounge, and at some point in time we were sensing maybe there's going to be like a bunch of sofas and we'll be kind of hanging around in this cozy room. But this room works well. Hopefully all of you are excited to be here. Happy to share some learnings, wisdom, and experiences. My name is Prateek Sharma. I manage a fund, Ahead VC, fairly young fund, so a startup in many ways, like many of you here. I'm a pre-seed investor, so invest right at the time when companies are getting created. I've invested as early as when two founders have a slide deck, and that's where the company is at. I invest very focused on software in the B2B domain. I really like the India-US corridor, so a bunch of founders I've kind of met recently who kind of visiting from India. Welcome. Hope to see you building big companies here. Other themes which I like and invest in are applied AI, which we've been very actively investing in the last 24 months. Have a number of investments there. Also, dev tools is an area of interest. So if any of you are building interesting companies there, happy to chat after the event. I've also, so that's kind of the investor life. I've been a founder in a past life, so I've also been on the other side of the table. I've raised several venture rounds, negotiated, won some negotiation and lost some negotiations with investors. So I have like a lot of empathy when I kind of get into these discussions with founders. Hope to bring, put on not just an investor hat, but also a founder hat when I'm kind of talking about a bunch of these issues. And with that, happy to chat more. On to Sanjay.
Thank you. Good morning, all. Just looking around at this panel, and everyone here is a VC and also a founder of the VC. So that we have two hats. So I'm one of the co-founders of Bloom Ventures. We started as what I call a micro VC with a 20 mil fund, and it's very interesting when you start small and then grow up. And we're investing from our Fund 4. We're on the road to raise our Fund 5, which will also be a similar level, about 250 to 300 mil. And we invest in the two Indias. We like to say the India for India. So we have a lot of consumer internet startups, and the other is built in Bangalore, Gurgaon, Hyderabad for the Chennai for the world. And that is two sectors. One is SaaS, which is of course now SaaS plus AI, and then also deep tech. So we do space tech, drones, autonomous ground vehicles. And I'm permanently here back in the Bay Area. We also have a large platform team, so we help our companies with fundraising, go-to-market, customers, channels, hiring. And we think that's a big part because, we like to say that our work starts when, after you've invested the capital. Founders can get capital from a lot of people, but the real work is after you raise the money. And today our check size has moved from, when we started, it was about 250 to 500K, and today it's anywhere from 2 to 5 million. And in terms of sectors, like Prateek said, on the AI side, everything from the application layer, we like dev tooling, slowly getting into cyber and security. But typically it's been application layer, and I think vertical AI is becoming very interesting, where founders are building the entire ecosystem and solving a problem very tightly around a vertical. So great to be here and to be part of this esteemed panel, and of course to interact with all of you.
Awesome. Hi guys, how are you? How many of you guys are founders here in the room? Raise your hand. Nice. This is the reason we like to come to these events, so for you guys. How many of you guys are investors in the room? Oh, shit.
Guys,
So, wow.
you can raise your hand.
Investors seems to be equal to founders too, and you guys are raising hand. So by the way, my name is Muthu Sudhakar, and I'm actually a founder. I'm an individual investor. I'm not a VC, so I'm trying to keep these guys in balance. Like, I'm not a VC. With that said, look, it's probably one of the greatest time to start a company. Like how President Trump calls it, if you don't like the Trump, you shouldn't be in America, first of all. I only care for US citizens here, so I'm in US citizen. So like right now it's building of America going on, MAGA. And I call it MIGA, make yourself great again, right? So making the money is what matters, not raising the money. Raising the money is easy, right? With that, I think it's a great time for entrepreneurs to build companies, raise companies. There's a lot going on. But I think the key thing as a panel we'll discuss is who you go after, the right investors. You have to judge these guys are the right investor or not. My advice to early stage companies is go to the small funds. Don't go to the large funds, right? There's actually a very nice article by Josh Kaufman from First Round. He called it venture arrogance, right? The bigger the size you are, the higher arrogance you have, right? There's a whole formula. And those guys survive with commissions and fees, etc. So, obviously, at some stage, you need large capital if you're in Series D or if you're doing later rounds, etc. But finding the right investor is important. Always, when you're pitching to VC, make sure that you're always over-prepared. Overdressed, over-prepared, create as many materials. These guys will judge you the day you walk into the room, the moment you say shake hands. Okay, they'll do everything to look at you from all angles, right? Their job is to do that. It's their money they're trying to make money on. So we'll cover a lot of those topics. I only focus on enterprise. I don't know anything about outside of enterprise. Within enterprise, again, look at AI and cybersecurity. Like right now, the only topics that I care is tariffs is higher than AI, and then comes cybersecurity. That's it. Anything outside like robotics, IoT, I can't make money in the next 5 years. So that's kind of the views I have, but we'll chat more.
So Muthu, you have one red card for saying Trump or tariffs. Okay. No more. I'll be kicking you out after that.
And he's wearing red too.
And he's wearing red.
By the way, Trump sent the executive order. I'll send your order to execute.
For folks who are at the back of the room, there's some chairs
that's two now.
free here if you want to kind of come grab some chairs. I see 5 or 6 chairs in the front row and then several chairs in the first 2 rows here.
Hi, everyone. My name is Anupam Rastogi. I co-manage a firm called Emergent Ventures. We started in 2016 with the sole focus of backing founders at pre-seed and seed stage, focused on the enterprise AI space. So that's all that we do. And we partner closely with founders in the early days. We lead rounds and then really help founders get from 0 to 1. So, building out go-to-market, refining their product market fit, finding customers, and then fundraising. And then I've been in this business for a little too long, 15 plus years at this point. So topic is term sheets and fundraising. So I've probably been part of at least 100 fundraising rounds that I've consummated, if not more, both on this side giving the term sheet, and then on the other side, once we partner with founders, really helping them raise the next round, which is where we get involved. And our partner companies have raised from pretty much all of the top 25 or top 10, top 25, all of the other funds. So a lot of learnings, tons of learnings. I think like Madhu was saying, preparation is really key. That's one thing I always talk about in these sessions is just spend 10 hours doing nothing but learning about fundraising and how VC operates, understanding the business, if you want to go the venture route. And then even before that, there's a if of whether you want to raise venture, if that's the right path for you. That only works for maybe 1% of companies across different types of businesses. But if you are in that type of company where you want to raise venture, go and study it. There's tons of content out there in podcasts, blogs, forums like this and other places. And I've seen the founders who do that just performing significantly better than others with similar kind of business, similar stage, especially at the pre-seed and seed stages. So looking forward to the discussion.
Hi, I'm George Tangadurai. I'm one of the founding partners of Avatar Ventures. We are about 5.5 years old, and we have about raised capital up to $800 million that we have invested. And very soon this quarter, we will launch our third fund that will take us beyond $1 billion. Usually our fund size is about 400 million. Basically, we invest post-seed. Once, so we are not pre-seed or seed investors. We look for opportunities where the startups have proven the product market fit, as well as deployed it with 2 or 3 customers where the product is proven, it's accepted, the customer is happy, and is willing to give purchase orders, right? So that's the stage we come in, what we call the inflection point. We are a classic VC with respect to how for what Ticon is. We invest across the US-India corridor primarily, and one of the criteria for investing in a startup is either the founder or co-founder has to be of Indian origin, or there is a team in India, right? Those are it has to fit in those two because that's how we differentiate ourselves. And the reason we started Avatar was to encourage the India startup ecosystem in our own way, right? With respect to what we invest across the board. We are vertical agnostic. B2B, B2B2C, and mostly software. And in some cases where the hardware is used as an enabler for software, like IoT and even AI right now. So that's the stage we come in, usually post seed, pre-series A, series A, and later. And the areas that we have been investing is in AI recently, not only just in enterprise, but also in AI applications. That has been kind of the last 12 months has been a lot of investments and a lot of innovations happening, pretty exciting. It's hard to keep track. Also in cybersecurity, which is another big one. And of course, and robotics, we have invested as well. So our portfolio is across the board. Enterprise, B2B, more than half of our companies are founded in India, to name a few, like HealthPlex, Insurance Deco, RateGain, all of these. And then of late, we have been investing in India, of course, fitting the same criteria of Indian co-founders or team in India, which is we invested in a few companies here, which are primarily AI and robotics. So, and it's really a pleasure to be with so many founders and investors, and looking forward to sharing our experience, how we look at it, so that you are better prepared and how the VC ecosystem in a way works. Thank you.
Excellent, excellent. I'll take the next 30 minutes to introduce myself. Sorry, very quickly. I'm a startup lawyer. I founded a law firm called Inventus Law. We work with founders mostly. When I was asked to moderate, and I've invested in probably, I hate to say it, but more than any of you guys, in mostly my clients. So I have also that perspective. I'm a founder, but mostly lawyer and advice. And we have a firm in Bay Area, obviously, but also a large office and growing office in Bangalore. So we also work with a lot of Indian companies setting up in the US and US investors, companies looking into the Indian market. So obviously always open for business. So if you have any questions about that, we can talk after. So Muthu, you got another penalty. It was my job to get a raise of hands, but now that we know this room is full of founders, that's exciting. Can we have a raise of hands on early stage? How founders who are early stage and looking for their first seed financing? Well, that's probably 50% of the market here. And then I assume rest of us, you can raise your hands. Rest of you are all looking, already raised your series A, seed financing and looking for series A or the larger round? That's great. That's great. I mean, that's almost 50-50, which is great because our panel is also As you'll see, two of them are Prateek and Anupam are early stage, I would say VCs who invest on seed stage, and then Sanjay and George are early stage but going into growth, and George certainly on the growth stage side. So with that, maybe you can talk about your areas of investments, stage of investments. What are you looking for the early stage founders? The two of you talk about what is the threshold, milestones, revenue, customers, IP. Obviously, AI has to be part of it in some form. What are you looking for? And Sanjay and George, you can talk about what you look for companies that have raised seed and doing to the growth stage.
I can. So look, guys, I'm being a founder. I can tell you, look, I invest in seed and Series A, right? I'm a founder like you guys. I don't do late stage B, C, D, etc. But in terms of what I look for it's always about like location. It's people. It's a team. It's a founding team. The good news with the current age is there was no one-man founding teams in the past. People didn't like that. Now I think there's a leader dashboard called Lead AI dashboard. You should look it up. A single founder will make to $1 billion revenue. That's like, so the good opportunity is now people are open to 50% of seed funds today, or seed companies are today at one-man show, or one person show, right? So that's a good thing. That has changed a lot in last 10 years. So I would definitely look at the person, the important. Second is how large is the opportunity. Don't come with a small opportunity. Like VCs always want you to say focus. My strategy has been is try to go after a larger opportunity. You have to have a bigger vision. Like how Google has like, I'm going to own the world's information. But how to go to market to that from day one, you may start with a small blade. Think of like a razor blade architecture. But if you just say, I want to do only meatpacking industry, I personally don't get excited. This is a contradiction you may get from different VCs. They'll say, oh, you want to be laser focused. So be prepared to that kind of questions. They'll also ask you, are you an application versus a platform? Don't fall into the debates, right? So you have to think through what is. Again, back to this. People, large opportunity, then the customers. I think one of you guys said about customers like design partners. Sign up design partner even if they didn't pay you. You don't need to have purchase orders. But if you have a design partner on which you are working them, and they can't be small, like again, depends on what you're building it. I'm used to building enterprise companies. If you're doing an SMB, maybe you get SMB customers. In enterprise, you need to get that bigger. You are like, you want to get JP Morgan, NVIDIA, Cisco, Workday, Salesforce, that kind of customers you want. So look for the design partners and customers. Other thing is milestones. Have a very clear milestone what you want to achieve, right? Keep the team small. These days, if you are like, look at Cursor, guys, 20 people doing 300 million revenue or ARR. So you don't need large teams. You would code assistant. Like 40% of the companies that I invested, code is coming from code assistant. Like Google announced 30%, 40%. Microsoft Satya announced 30% yesterday. So if you see it, code assistants, you have to use it. So keep your costs down, all right? Use AI in every part of your operation, from marketing. No need to use Figma and Canva, they're done. Right? AI is generating code. So don't use tools, use AI tools, but don't use yesterday's tools. So you apply AI throughout your marketing, sales, SDR, and all those operations. So I want to see that in investing in a company.
Thank you, Muthu. Yeah, Anupam, please.
Yeah,
so sorry, let me pick up on that, right? Muthu brought some good points, but go deeper into the specifics, right? If you're talking about milestones, would you invest in a company with 100K ARR, or what are the specific milestones you look for the early stage? First check.
Me?
No, Anupam.
Okay. Yeah, so, as a pre-seed and seed investor, so we invest everywhere from inception stage, and this could be a person with or without a PowerPoint, all the way to pre-series A rounds, which could be, let's say, a $5-6 million round where companies raise maybe 1 or 2 rounds before and is on path to a Series A, but not quite there yet. So I'd say, so nothing is too early, so you're not looking for any specific ARR number. I think at the earliest stages, at the inception stage, what we're looking for is basically team, market, product. That's the order, and in that order. So team, I think, when to talk about. So a lot of subtle aspects to it, which I think first one is really we're looking for alignment. So as a firm, we are looking for ideas and businesses and people that are looking to build a very large business. So I think this is one area where often at the very earliest stages, you have to make sure there's alignment with who you're talking to. With venture, and especially, for example, a firm like ours, we are really interested in seeing that path to a public company type scale one day. Of course, not every company will get there, but we want to really hear about what's that big vision which gets you, and are you really excited about that? Because for a lot of folks, a 50 million, 100 million outcome can be really life-changing, can be an amazing outcome. That's not exciting to 98% of VCs. So you have to really make sure, so you have to have, basically you have to really marry these two things. I think Madhu touched upon that a little bit, this big vision. Where do you get 10 years from now, 5 years from now? What are those potential steps? Of course, this will change, but how do you think about it today? And the micro here and now, that generally has to be pretty narrow in the enterprise space that we are at. Generally, to break in, you have to have a fairly tight-knit wedge, or fairly tight wedge, which could be either by specific industry or use case or form factor. But we are looking for those joining the dots, and the best founders do that really well, is they have this wedge today, which is attracting the design partners, and then at the inception stage, we're looking for that clarity of what you're building, and that clarity can either come from having design partners already, which would be sort of a seed type round, where you're saying, hey, here are 7 names, GE and Cisco and this and that, which are going to be 200K customers. They're already piloting it, and I can get feedback from them. Or you can manufacture that by going and talking to 50 to 100 potential customers and doing an amazing customer discovery, which can really help you. So I see the best founders have done, usually they've spoken with several dozen prospective customers. It takes a lot of hustle, a lot of work, but it brings clarity to yourself, right? You're putting in a tremendous amount of time, massive opportunity cost, and often, the product that you start with is not the product you're building 2 years from now. So why not get that input from the market on day zero? Go talk to 50 to 100 customers, maybe even before you leave. And those are conversations of getting feedback are actually much easier than sales conversations. Same person, same messaging, but you say, hey, I want 15 minutes of feedback versus, hey, I'm selling this to you, here's what my product does. Just look at the response rate, will be 10x more if you're asking for advice. So you have that benefit when you're starting off. So it's a little bit easier to get to those 50 to 100 conversations versus 50 to 100 sales conversations. So I'd say do that. The best founders do that in a very structured manner. They'll have drawn out insights. They would say that, hey, here are 10 who can be prospective customers. Here are 25 who it's actually not relevant to. I'm not going to build for them because of this reason. Or here are people who will not buy. So that's one question I often ask, hey, who will not buy from you? And many folks will say, hey, everyone is going to buy from you. That's not a good sign usually, because everyone is not going to buy from you in the first year or two. But if you can say, here are manufacturing companies of this size in this geography are going to be the ones who are most likely to buy from me, and here is why. So we're looking for that signal, and that signal could be discovery or actual customers in the case of a seed round or a seed plus type round. Maybe I'll pause there and let others add.
Yeah, no, I'm not going to let you pause. I'm going to push you on the specific question. Would you invest in a company with 100K ARR? And don't worry, I'll also ask Prateek the same question. And obviously it depends, but if you have 100K ARR, what else are you looking for? And also talk about, what as a founders, how should they be pitching? I get asked that question a lot, and I have obviously my thoughts, but how much should they be raising? What valuation? Assume everything else remains the same. They have the design partner, everything that, all the good things Muthu outlined they have. And we'll talk about the founder personality separately. But other than that, if they have all of this and they have, the revenue is 100K, what else should they be looking for, and how much should they be raising at what valuation, ballpark?
Yeah, ton of art in there, very little science in the valuation especially. To the 100K question, absolutely. So 3 of my last 4 investments were 0 ARR, so pre-ARR, and also 2 were pre-product, so idea stage. So we do idea stage things as well. But that depends so you have to understand with each VC that you're talking to, you have to understand what's there. Everyone will have their own sort of preferred spot. So we are very comfortable going early. I'd say to your question on what are we looking for, so I think it is basically that we are looking for that path to a larger market and that conviction. So it's not just that, hey, it's some imaginary market 10 years from now, but also, as a earlier investor, we continue supporting our companies, but we don't lead Series A round. So we also have to see, hey, can you actually get to a Series A in a reasonable amount of time, 18 to 24 months? And the Series A bar right now is really high. And, I'll let others chime in here, but what we are seeing is just as all these companies have come into the market, which are going really fast, that bar has moved higher. So we are looking at that really high bar and saying, hey, can you get to a 2-3 million ARR with some level of repeatability, 5x plus growth rate, maybe going to 0 to, infinite growth rate, technically 0 to 2 or 3. in 12 months after you start monetizing. So in addition to a lot of the long-term TAM, of course, meeting of the minds of the founder, really understanding product differentiation, we are looking for that sort of, the tactical thing we're looking for is also, hey, can this get to a good Series A in the next 18 to 24 months, and what does that path look like? So again, marrying those large, big picture TAM, how does this get to 250 million ARR in 7 years? How does this get to 3 million ARR in 18 months?
Prateek is very eager to hopefully disagree with you because, I mean, you're both my friends, so hopefully we can have a fight here. And
No, actually, I don't disagree.
Okay. So tell us your perspective, right? Exactly. Yeah.
Just kind of building on what Anupam said is, I think it's important to kind of understand that 100K ARR is one of like 50 parameters that VCs will kind of look at. It is an important number. It's good to have 100K ARR. It's 100K ARR is better than zero ARR, but it's not everything. There likely might be several companies here who raised like a big chunk of capital at zero revenue, and other companies who are at like 700K of revenue and not able to raise capital. So both of those things coexist. The way I try to make sense of this is like thinking of kind of creating a scorecard for yourself. The more checkboxes you can get on that scorecard, it increases the chances of raising capital, and it increases the valuation at which you can raise capital. What's on this scorecard? First and foremost, the team. I think many of us have talked about the team. It is about who you are, what have you done in the past, and specifically in the industry and the problem that you're building for, what's your right to win? Why? Because like the fact is, if you're kind of working on an exciting problem in an interesting space, there's likely 100 other founders who are kind of going after it. Everything is kind of super competitive, no matter how emerging an area, especially like in the Bay Area and in Bangalore. Lots and lots of smart people, capable founders. Every exciting space is competitive. So you have to kind of build a case about why you have the right to win. That's a very, very crucial point of how you get extra scores on the team. So that's the team. The market, space, timing, what you're kind of building in, why is now the right time, why the specific thing that you're building is interesting. Everything about customers is super valuable. I think several of us have talked about discovering that customer insight. What we are kind of looking for is that unusual, non-obvious insight. Because again, like think about it, that most of investors would be talking to hundreds and hundreds of founders. So we've kind of heard that marketing automation idea probably 100 times. You can. I'm not saying that you shouldn't build in marketing automation, but if you are kind of building in marketing automation, I want to hear something unusual. I want to kind of hear something which I don't know. Like if I know more about your space than you as a founder, then you haven't done your work. So just kind of really dig deeper, and I think as Anupam kind of mentioned, and Muthu also mentioned that talking to your customers, that's the best way to figure this out. I'm not out there in the industry talking to customers, you are. So you actually have that path to discovering the secret. We are kind of looking to learn about what you have learned, and that definitely gives you a big score. And I think all the revenue traction kind of comes after this, especially at early stage. At later stage, how solid the business is, that's crucial. At early stage, revenue is probably, it's a lagging indicator. We're looking for like a lot more, which will lead up to meaningful revenue. So for example, what will excite me, even if you don't have a lot of revenue, is if you can show me some velocity in whatever area you're doing. If you can show me some velocity of building product, some velocity of talking to customers, wherever you can show me that you not only are a deep thinker, but you are also able to move fast, that's what will kind of get me excited.
So I'm probably disagree on one comment there. So I think even though he said that he'll invest with no revenue, or both of you said that, I think, look, if you have a choice, get revenue, guys. As you said, the check marks. Like if you want to elongate your life cycle, elongate it to a point where you go to the VC and investor with revenue. Anytime you have a paid revenue versus somebody, use your design partners to build your product, but close revenue. And in AI, it's not a 10K, 20K deals. Like I'm giving from my perspective. Like these days, your $500,000 deal is the first deal size you're signing it. That's the land, not the expand. right? These days, people are giving for AI is important. Your underlying GPUs will cost more if you are doing any of those things. So remember, you are in, I call it AD. What is AD stands for? After DeepSeek, not after death, right? Then BC, I used to talk, what is BC stands for? Before ChatGPT, right? Things have changed so much, guys. You need to generate revenue. People are willing to pay money. Go get $1 million deal, $2 million deals, $500,000 deals, then these guys will look at you. That's very important.
Let me, maybe to get brownie points, I'll take a contrarian position.
Excellent, excellent.
So no, I actually agree with most of that. I think it depends a lot on your product. So for very enterprise-ish products, I think there is good revenue and there's bad revenue. Obviously, if you have really good revenue, which is you're getting good deal sizes and that revenue is going up quickly, and it's constant revenue, that's great. But don't manufacture revenue with 5 different customers. One is paying you 5K, 10K, 20K, and all of them have different use cases, and half of them are going to churn out after 6 months. That will actually hurt you much more than not having revenue. You're actually better off not having revenue and have that promise. And I'm seeing this actually, especially these days, even for even larger pre-seed and seed rounds, companies with pre-revenue are getting more attention of some of the other investors. Then sometimes we'll do a pre-seed and company goes out a year later and they have less interest than what they had a year back, even where they've got a 500K revenue or something. And partly because of what I was saying, like they have maybe 5 different customers, 5 different use cases. Maybe the retention is not that high, or people have not yet seen. Now they want to see retention. Now they want to see NRR. Now they want references from all those customers, and maybe they're not referenceable yet. So I'd say I'll just add that nuance that revenue is great, but it has to be quality revenue, and it has to be, I think, a uniform use case type revenue.
I completely disagree with you guys. Remember, you don't have a sugar daddy and sugar mommy. Any revenue is fine. And there's no churn and NR, GRR at the seed stage. Remember, you're a seed stage. You're an ant. You're not an elephant. So anybody gives you money, take it. How many are your use cases? Till you get a sugar daddy, sugar mommy on your side.
Maybe you should do a A/B test. Half of the side raises without revenue.
Raise your hand, guys. Do you want money or not? Raise your money.
Maybe I can offer a perspective.
Andy, yes.
If you just look at I think everybody in this room knows we're still coming off a pretty severe market correction for a couple of years ago, and venture deployment still remains relatively modest, particularly outside of AI, right? If you peel back all the funding that's going into the AI space, it's pretty darn hard to raise funding. I think part of the argument, between my fellow panelists here really is somewhat stage dependent. And so, if you're really early stage pre-seed, it's really all about the team, right? And you hear that reflected in terms of what these folks are looking for in terms of making that initial bet. But I would sort of put my chips behind Madhu's statement around today, the expectation of founders as they're going up the stack to raise funding, you really want to see some real traction, right? Particularly with the advent of AI tools, how efficient founders can be with very little capital. I think there's expectation when you actually sit down with an investor today that you have some revenue, that you have some uptake to differentiate yourselves from other entrepreneurs, particularly in advent of AI tools. And I think, we're talking about 100K ARR. I think there's expectations, frankly, particularly when when you're getting towards the seed stage of something much larger than 100K. $1 million ARR used to be the sort of the milestone that you would tick to kind of show you're on your way to product market fit. I think those expectations are higher today.
So Sanjay, I know Sanjay Nath is, I've written these words, omnipresent and ambidextrous. I don't want to sound like Shashi Tharoor, but I really believe this, that I go to Mumbai and Sanjay's there, I go to Bangalore, Sanjay's there, I come to Palo Alto, San Francisco, and obviously here. So he's all over. He's also ambidextrous because he does early stage, so we have clients that have just started and they've got 100K revenue, and Sanjay is very interested in talking to them about investing. He's also invested in big growth companies, Atomic Works, and large companies that are growing. So he has a great perspective of both sides of it. So Sanjay, would love to hear your thoughts on agree, disagree with what's been said so far, and then as a growth next Series A investor, what are the thresholds you're looking for, and how do you see the market?
Thanks, Anil. By the way, is there a prize? What is the prize or penalty for the co-panelists or both? Is there?
It depends, as you investors always say, it depends on the investor.
Because I think Mudu is going to win by a mile. So but it's very interesting to have your perspective, right in the middle amongst, a lot of diversity. So, I think you'll have all, of course, George is going to add, but we've started with some really core first principle questions, right? Got into the depth of what founders should think. So I'll address a couple of points about, so I started as an angel investor. In fact, I sort of cut my teeth. I wasn't a VC. I was a management consultant for about 10 years in San Francisco and got very intrigued by VC in the Valley, but started in India through the Mumbai Angels. My partner Karthik and I started Bloom. Was there for 10 years, about 3 years, moved back here. So at my heart, I'm an angel investor. Anil knows, I like to meet founders in a coffee shop, but as you scale and you build an institutional platform, it changes, right? Capital brings you scale and it allows you to back your companies, you're all the way, much longer, not just the seed round. So really enjoying that. So I'll share what, from my frame, what we look at different stages. Because if you look at the core, when you pitch to VCs, a lot of my panelists touch upon it's TAM, which was total addressable market, and team, right? So if you think about the two, sort of, making them sound like buzzwords, but TAM and team. And I think the third part, which is becoming really important, is that what is that, why are you positioned to win? Why are you primed to win? What is your right to win? You could also ask in, hot competitive deals, you ask the VC, what is the VC's right to win? And similarly, you flip the mirror and ask the question. And I think another part which has become really important is why now for the customer? What is this a must-have or is it a nice-to-have? Is this a vitamin or is this a painkiller? And can the customer do without you? I think these are some things we think about. And one of the things that I ask founders a lot about is, especially Anil, as we've grown from the 20 mil fund, our average check size was about 250K, and now we're doing as high as 3 to 5 million. We actually spend a lot of time diligencing the founders, like Mudu was also talking about, that why are you doing what you're doing? One of the things, when all of us drive on the 101, I like to ask founders this question: that what is your 101 freeway tagline? And if you had a billboard up, what is the tagline going to say? What is it going to say today? What is it going to say in 10 years? You want the founders to think about what they're going to build in 10 years from now, and then come back to the milestones, what they look like in the next 12 to 18 months. So I think if you think about what we look for, the core essentials are the same. It's team and it's a TAM, and then why is this so critical for your customer? What will they do? How are they doing it today? And why do they need you, right? Are you going to displace some software? How compelling is it? But the weightage changes. I think the earliest stage, like Prateek and Anupam were talking, the weightage on the team is much higher because they're essentially backing that founding team. And I think it is more than a certain number, like 100K or 500K. It is the proof points. And I would love to see 3-4 proof points that get you to 100K, like 25K each, which can, like Madhu was saying, quickly land and expand versus one customer that gives you 100K. Because if the churn, Anupam, you were saying, if the churn is high, you've lost 100% of what you have. So the core, I think the core essentials remain very much the same, which is the team, TAM, and how compelling is it for your customer, but the weightage changes. Now, when you get to return the mic to George, you're kind of starting to invest in a balance sheet, right? You're investing the product is PMF. You're looking now to see, have the co-founders are they able to scale? Are they able to build a team? If they have a head of AI, is that person able to inspire and bring other smart engineers to work for them, right? Then your ability to sell, scale, and hire becomes very, very important. I think we've seen, if we look at some of our best companies, their ability to hire a great team under them is one of the biggest single differentiators. I do agree that you don't have to have equal founders. Maybe there's always one main founder, correct? But can you build a great team around you? It sounds like, Anupam, you were saying art. It sounds very simple and soft, but it's a very difficult thing to do. So, yeah, Anil, that's excellent.
I want to add one thing he said. What's the tagline on 101? It should be make money, guys, for us. Nobody made money. These guys did not make money. I did not make money. You did not make money in the last 5 years. So that should be make money, that theme.
Exactly.
You should get that, Sanjay.
So George, you are the big daddy here. You have the largest fund. You look at growth stage. Wrap up this part of the discussion with, like, would you look at companies with 100K ARR? Would you start tracking? Should founders be even contacting you at this stage?
Yeah.
What are the minimum that you look at, and then take us forward from there? Maybe give some examples that you can share.
Yeah. My colleagues in the panel covered most of the stuff, but let me kind of tell some points from my point of view or Avatar's point of view, because we come a little later after the PMF is proven. There are at least a few customers that you have deployed, that the customers like your product, they see it's a need for them rather than a want for them, right? And basically, they are paying customers, right? So we usually come after you have crossed $1 million or $2 million in revenues, right? So that is kind of somewhat of a given. What are the 4 or 5 things you look, and might come as a repeat of what my colleagues here said. One is, first of all, you're looking at the product and technology. Is it a must-have for the target market, right? Do they need it? Will they pay for it, right? That's kind of the first part. Now, the second part is, what is the market opportunity? Obviously, we want to make sure from where we invest, we want to make sure the market opportunity is significant, right? Which is, again, a no-brainer. But what we are looking at is the story of the founder, right? Because when we are coming in, we are looking at, okay, how do I partner with this company when I invest to take them beyond $100 million in revenue, right? And we are not worried about how fast we do it, right? But can we, work closely to get there? Are we convinced? Is there a conviction, right? And there's another one that comes into play, which is the team that the founder has pre-seed, seed, versus when you're coming, into post-seed stage, or Series A, if you want to call it, or pre-Series A, is, do you have the infrastructure or the capability to do two things? Primarily, that's where some companies struggle, and I personally am, going through it myself, is in the portfolio is, do we have the right, scaling infrastructure, right? One is go-to-market, okay? And that is where, especially when you're trying to go across geographies, many of the companies that, or at least more than half the companies that are in a portfolio are Indian-founded, India-based companies who want to grow here, right? Because they want to grow their business in the US. The go-to-market in the US is a different challenge. You have to have the right people, right team, et cetera, to build that itself is a challenge. Okay, you can fail or succeed, or even lose time or money as well, right? That is kind of, and the same thing is deployment, execution. Okay, to execute at pre-seed, seed is one thing. To go beyond 2 or 3 customers into multiple customers, and even in some cases multiple units, if you want to call that, right? We have some companies that do that. It takes a different, type of team, expertise, everything. So, what type of team the founder builds with respect to go-to-market, with respect to the execution, comes into play more than technical. Technical stuff is already proven by the time you go to post-seed stage, right? The interesting thing that we also look at is, what is the business model, especially with AI? So probably some of you might know, but this is very interesting. The business model is kind of has evolved. It's not the classic, SaaS or whatever, right? Device as a service, platform as a service. Interesting, the business model, especially with AI, is moving towards outcome-based. Okay? So we have 3 or 4 portfolio companies, very interesting, and they are growing very fast. Their business model is outcome-based. If the outcome is not there, they don't get paid. And they are so confident about their product that they have beaten the outcome benchmarks. Right? One company went from 30% outcome success to more than 80% outcome success in just 2 years. Right? So that means their revenues have completely doubled, tripled, right? So it also proves that your product is evolving, because AI by nature, it's also learning along the way. So the business model we look at, right? I mean, is it, and of course, is the product or technology that you have has a sustainable moat, right? At least for the next 2 or 3 years, because competition is going to come whether we like it or not. And so you do have a sustainable mode. So these are the kind of things we look at, and what is the story of the founder? How is the founder looking at it? And these are the kind of things we look at before we kind of develop the conviction that this is the right one to go. And then as part of Avatar, and I'll be glad to meet you if you're interested, if you're in that stage where you're past $1 million in revenue. We also work with early stage VCs, right, where we identify companies even earlier who are in the few hundreds of K, right? And we kind of keep a tag on them, right, watch them, and with the VCs, early stage VCs who have invested, and see when they're ready to graduate, we are ready to look at it, right? So this kind of, what we look for primarily, obviously we have to look at the financial stuff, that's fine, but this is the kind of the high level, that we need to develop conviction before we invest.
I want to quickly sort of sidetrack on something, Muthu, you had said earlier, and want to bring in Andy as well, about pitching and personality. It shouldn't be on the fundraising, but that's such an important part of all of this, and I'd like to get everyone's perspective, but reintroduce Andy very quickly. Obviously, he's been a great friend. Most people in this room don't realize he's more Indian than all of us, many of us. I've traveled with him in India. I've seen him eat his chicken curries and everything else, so he can hold that. He's been on the board of TIE for last 100 years plus, so he's been around. And it'll be a great sense of your perspective. You know so many successful Indian entrepreneurs that have made the journey over. What is it that you think in terms of personality that makes them work versus to be improved upon, can be improved upon? If you want to take names, even better, make it more controversial. But then we can come down very quickly what each of yours perspective is in personality, how that goes in, and the kind of pitch, how that goes into the pitch, and what founders can do to make it better from your perspective.
Oh, there's a lot to unpack there, but I guess I would start with the context that for Silicon Valley Bank, I run our international relationship management and business development business at the bank. So I work with startup founders from around the world, and there's some really interesting cultural attributes when you start looking at, when you start speaking to entrepreneurs in Canada, in the UK, in India, in China, Israel, and a lot of it comes back to impacting the way you pitch and the way you communicate with investors. And I think everybody at this table would say certainly that, in those rare interactions that you have to make an impression, you have to make the most of it. And to give you an example, I was based in London for the bank. I set up our first business back in 2004, and I lived there for 6 years, working with a lot of UK and European entrepreneurs. And for the Brits, it's very common for them to they call it kind of the tall poppy syndrome, right? They're kind of culturally more modest in terms of how they portray their businesses. And so when they start talking about their business, it comes across, the confidence doesn't come across, and then it doesn't translate into the numbers and the deck that you're putting out, that, they have an idea, they want to build a company, and they're showing a business that in 5 years' time might make it to like $20 million. And you're talking to a venture investor who's hoping for a 10x fund returner. And so you need to be prepared, and you need to have that ambition. And everybody on the panel talked about TAM, right? The size of the opportunity. And so, and of course, this was a long time ago, and sort of back in the early 2000s. I think things have changed there, but it is a nuance that I've seen in newer emerging, tech hubs where venture is a newer game. Right here in the U.S., particularly here in the Bay Area, it's a pretty mature business. But even in markets like India, where there sometimes is a fixation on the technical aspect or the product versus the market opportunity. And again, so your ability to communicate really efficiently in that short period of time and hit upon the right metrics, and by that you need to do your homework in terms of who your, if you're a good entrepreneur, you're going to do your research in terms of the investors that you're talking to. What spaces do they like? What stages? And if you're, talking to someone who's not in your segment and not at your stage, it's a waste of, it's always good to begin a relationship, but essentially, it's going to be a dead end, at least initially. So there's a lot more I could go on there, but I'd say those would be certainly some things to think
Thanks,
about.
Andy. Most of the Indian founders I know have the reverse problem. They make up numbers that are not, out of thin air, and they lose credibility at that point, billions of dollars, and I've started hearing $1 trillion, and I had to check, it has 12 zeros. That's a lot of zeros. Share your perspective on if you have a founder that's making up these numbers, or not making up, but have these numbers, Prateek, maybe as an investor, and that's BS, right? How quickly does that go down, and what is your sort of, again, advice? And I'd love to get everyone's very quick thoughts on that. And anything else that they can do to make their pitches better? Personality, pitching, data, specific numbers.
Yeah.
Certainly ambitious in terms of getting excited and investors excited, but what is the balance, right balance for all of them to make?
Yeah. I haven't seen $1 trillion TAMs yet, but I'll keep an eye out for that.
I'll send you the founder.
That's what we need. I think credibility point is a subtle but very valuable one, and we'll talk about confidence, etc., in a bit. Irrespective of what your style is, you want, this relationship works if I as an investor can trust you as a founder. And from the very first meeting, you have to start laying the foundation of that trust. If you can lose trust by talking about your market and having $1 trillion TAM, and we know that it's not $1 trillion TAM. You'll kind of immediately lose trust and credibility. You will lose trust if you don't accurately portray where you've been, what your background is, what you're doing. So the subtle kind of balance there, of course, is you have to be excited and you have to convey that excitement while being very, very, very grounded, in fact. It's not impossible to do. It is hard to do because in many ways, you're kind of inside of your business. You're inside of your category. You know everything that's kind of going wrong. And startups have things going wrong all the time. I've been inside early stage startups. I've been a founder myself. I sold my company to a large public company. I've been inside that large public company. If the company is growing, if any company is kind of trying to stretch their boundaries and go beyond, it's a shit show inside. Scale doesn't matter, which means that you are inside that shit show, and yet you have to kind of convey this excitement. That is the balance to kind of capture, but again, not by fudging numbers and not by overstating what reality is. So that is just about the credibility piece. About specifically founders who have not spent enough time in the Bay Area, a bunch of folks here are probably landing here from India. You're usually missing some context about your particular category. So do spend the time getting a sense of what is happening in your particular category in the US, because this is where you're trying to sell. So build that knowledge, build that sense of what's kind of happening at early stage, medium stage, later stage. Have that grounding of fact before you position your company and your product in that ecosystem. No matter how magical the company or the idea seems in your head, it will be a part of an ecosystem. So get that realistic sense of what the category and the ecosystem is. Where do you position yourself? That will bring you a lot of credibility. Hopefully, it will bring you a lot of clarity yourself in terms of how you build out your business, but it will definitely improve the quality of your pitch. I would also say that spend some time, as Andy mentioned, researching who you're talking to, and then maybe also asking questions of your investor. Oftentimes, especially like new founders raising first time, I'll see them kind of get into pitch mode instantly. You'll not spend any time kind of trying to ask questions, getting a little bit of sense of who this person is. You, of course, should have done some research before, but even when you're in the conversation, get to know the investor a little bit more about what specifically they're interested in, what they're looking for, and use that context to tailor the pitch that you have. If you're just kind of repeating the same pitch over and over and over again, you will not really feel it because you are in that automated delivery mode, and you'll also not tailor it to the person who's sitting across you.
Yeah. Sanjay. And get feedback from your spouse, friend, whoever. Do a pitch and see if they'll give you those feedback that it's repetitive, boring, whatever it is.
Whoever you can. Ideally you want to kind of get it from someone who understands your category in your business and maybe some investors. If you don't have them, just tell your story to a few people. You'll kind of immediately catch things which are not working.
Great points. Anil, to your point about, truth and integrity about numbers, some of you in the room may have heard this, that there's more fiction in Excel than in a Word document. So that's interesting, right, if you think about it.
It's called creativity.
So a couple of thoughts. I'll just touch upon some of them, just reinforce rather than making new points. I think one is, Mudhu's a straight shooter, right? Talked about make money. But I think when you're approaching that, think of your VC in that meeting as your customer, right? It's like know your customer. What is a VC? You're actually dealing with OPM, which is other people's money. Of course, as GPs, you're supposed to, all of us are supposed to put our own money, but it's somebody else's money, which means it's a fiduciary responsibility to go and create real value, outsized value, because otherwise you can get that in the public markets, which means I think what you're looking for is you have to articulate your scale of ambition. And of course, you have to be truthful. What is the VC looking for? How do you make money? By backing founders who are really going to disrupt the industry. And I think what is good to see, even in India, and you look at the Indian IPOs, some of us also invest in India, is that has remarkably changed, radically changed, and somehow, obviously, Indian origin founders are running. The top companies are also involved in, I'd say, 1/3 or maybe half of innovation that happens in Silicon Valley, which is great. So I think you could say you want to build a $1 billion business or $1 trillion business, but how are you going to get there? I think that path of how thoughtful you come across is very, very important. So I think the scale of ambition, if it comes across, then you can articulate how you're going to, make money. And of course, the VC also makes money. I think two other points. I think one is preparation and research. Andy touched upon that. I would approach, I like it when you approach it as a conversation versus a pitch. I think you made a point that, you don't start the meeting, look at your watch and launch into pitch mode. It's very interesting to ask, be thoughtful and ask them one or two questions to start the meeting, because you can then tailor your pitch based on that, versus if you do your pitch and you ask your best questions at the end, you've lost that chance. And I think of approaching like an interview. I find the most interesting, if I'm interviewing a candidate, is the Q&A part at the end, because that's the time you can build engagement. That's the time that shows how much the candidate has researched the company. Also within the firm, there are different partners. You talked about personas. A VC firm also has, I know Anupam and Ankur very well, the two co-founding partners. Same values, maybe slightly different personas. So it's important to also understand that, right? How a person thinks, likes to be approached. And I think, you have to also know yourself. I would say be yourself, but of course you only get one chance to make a first impression. You have to come out all guns blazing, but if larger teams have analysts and analysts are taking notes. We go and pitch to LPs. The LPs we've met after 3 years, they pull out notes that they've seen, and sometimes you've forgotten what you said, and they tell you this is what you said. Yeah. So you have to be truthful. I think scale of ambition, how you're going to build a team. We are not always looking for the right answers, but how you're thinking about it. I think the thought process, has the founder thought about it? Because like you said, shit's going to hit the fan. Shit is going to hit the fan. How are you going to deal with it? How are you going to react? So I think preparation, then approaching the pitch, not as a pitch, but as a conversation. And then some proof of like context. I think that's very important, of what you've done in the past, how it informs you, why you're the best team to back, versus saying, more like a PowerPoint deck, oh, this is a great idea, I'm going to go after it. But why should we believe you? Some paths in the past that connect the dots. I think those are some points.
Thanks.
I have a lot to say, guys, but I'll keep it short given I'm running out of time.
15 seconds to be.
Yes. So firstly, look, it's you. You have to come out. First impression, best impression. It's like going to the movie. You don't see the premiere again one more time. When you meet that person, you got to make the person. If you have to dance on the table, dance on the table. They have to remember you. Get to their head. Whenever they sleep, they should remember you. You make an impression so much that when you wake up, this guy cannot. You have to be in their head. Get to their head. Not like what this guy is like. You don't want to be like Andy. Andy is too modest. Like, I'll tell you exactly what. You want to be like Mark Benioff. Or be like Frank Slootman, my old boss at ServiceNow, right? You want to be like Sam Altman. Like, you want to have a personality and a character.
You want to be like Mudhu.
Right? Thank you. But look, I mean, guys, pick a personality that you like. But you have to be there. But the other thing that I want to say is, people talk about you need to have a super skill. Figure out what is your super skill. Figure out your superhero. You will like the super lady, super girl, which are Superman. Figure out who it is. Be like that person. That's very important. What is the other things that I want to say? I think you covered some other topics I want to say.
I'm sorry, let's keep going because we'll come back.
Sure. Why don't you go something else?
Yeah, so I think a lot has been said. I'll just make a couple of tactical suggestions. I think one is, again, in the enterprise space, which is where we focus. We see a lot of founders, come from tech backgrounds. I come from a tech background myself as well. End up talking a lot about product. So typically your first meeting will be 30 minutes. And there have been many, many meetings that I do where it's minute 28 and we're still talking about product. And we haven't talked anything about the business at all. So just keep in mind, VC as a customer is very different from your enterprise customer as a customer. Start with a fresh, completely different deck, different story, a different thing that VC is looking for, right? So there's market, team. Don't be hesitant to talk about team. Just talk about yourself first. Talk about how it relates to what you're going to talk about. And the other tactical thing I'll mention is what I suggest for these 30-minute calls is a 10-10-10 pitch. Practice a 10-minute really sharp pitch. Of course, if you get interrupted or make it interactive, it'll be more than 10 minutes, but you should have a practice 10-minute version where you're hitting all the big, TAM, vision, with all your energy, all of your, product, everything in that 10 minutes. So the first 10 minutes is getting to know the VC, the rapport, and understanding what they do. The next 10 minutes is your pitch, and the remaining 10 minutes is your Q&A. And obviously, it may overlap because someone is asking you questions. But if they don't ask questions, then you just save 10 minutes for yourself and for them, because that means they're not interested. So so it goes back to the point I had made earlier about preparation. So just get to know the VC process, have a sharp pitch, and you'll see a big difference just from that.
Hey, one thing that now I remember, I'll get my 15 seconds back. I think the key
this is new.
The product side, guys. You have to own, either you're a product guy or an engineering guy or a sales guy. Don't be somewhere operations, marketing. You got to, right now you're in a point where you need to know where your strengths are. When you go to these VCs, drill down inside. Like, one person should be able to build a company. So that's what these guys are looking for. Really strong founder.
George?
All excellent points, so I'm just going to add a few. I think in the first 15 to 20 minutes, if you are not able to crisply articulate, and this is kind of, not a surprise, if you cannot crisply articulate and get the audience, in this case the VC, say, aha, there's something here, you lost it, right? So the first 15, 20 minutes, how you can articulate what you're doing, what your company is doing as a product or technology, that's number one. Number two is, because if it takes 1 hour, 2 hours to really get to understand what it is, then you'll have a problem with the customer too. The second thing is the credibility and trust that you build in the first 1 or 2 engagements is very important, because from our point of view, where we come a little later, we are talking about a 5 to 10 year relationship, quote unquote, right? Depending on whether it's you grow and become successful, or there's an M&A, or there's an IPO, right? So we are in this journey together for a long time, and so initial stage, how you present the product, the projection, the financials especially, is very important, because what we do as VCs, this is a kind of openly sharing, we do our own math, okay? If our math and your math doesn't align, at least by 20, 30% gap is okay, but it's off by 50%, we have a problem. right? Because you might be showing a hockey stick, and we will look at the competition, we will look at, the willingness to pay. The other thing is, because we come after the PMF, we also make checks with your customers. You may not know it, right? We do it. It's part of our process. So these are the kind of things that you have to keep in mind, when you're engaging with the VC. What is your story? How are you going to articulate it? How do you build trust and credibility, especially with your story and with your financial projections, as well as what you are saying that your customers are saying about your product?
All excellent points.
One second. 4 more guys. Make sure that these guys fear of missing out. These guys want to make money. They have not made money. Scare the shit out of them that they have to partner with you, otherwise they'll lose you, right? 4 more. Remember that. They need to be coming to you, not you going to them.
Great. Great points.
And
and we have more. Yeah.
No, I'm not, rebutting.
You remember me in your sleep?
Putting me on the spot.
I was going to say very quickly that if most of you go home tonight and have the image of Muthu dancing on the table, we've all done our job really well. So I think we've done well. Yes.
Just 2 quick points. I think one is about human behavior, human psychology. I think, George, you made a very interesting point. I remember reading this, that in any 1-hour meeting or interview, the other person is forming a hypothesis in the first 10 minutes. And the rest, 50 minutes, 45 to 50 minutes, is either proving or disproving that. So you have anything, right? Personal situation in a VC pitch, I think that's one. And I think the second, that's the main point. I've also forgotten, because this is like a distraction sort of radius. Yeah.
I'm just going to wrap up this with a very quick thing, that know your investor, and everyone said it in different forms, but to give an example, there are also things that they don't invest in, right? If you're a healthcare company and this VC fund says we don't invest in healthcare, don't waste their time, don't waste your time. If you're a early stage with the 100K ARR, don't go to George. George said he'll be open to it, but probably not the right investor at that stage. Maybe go through Anupam, get him involved, and Anupam can bring George for the 100 million check, right? So
actually, Anil, I remembered. There's like a 20-second lag, so I remembered now. I think the other point is about self-awareness, right? About, I think you use the word superhero, but if you ask a founder, what are you good at? And they say 3 or 4 different things. Yes, they're a strong founder, but so self-awareness of what all of us are really good at. And then here are the gaps. This is what I'm going to need to succeed, and here's how I'll fill it. The second-time founders, we've seen not only do they know how they're going to build up the profiles, but sometimes the actual names of people. Here, I'm going to pull this person out of Cisco because they worked with me. And so I think that tremendous self-awareness and a strong founder is good, because a lot of people feel that if I say I'm not good at this, that's a sign of weakness. But actually, it's a sign of strength, because no person is superhuman, but you're still pulling the team, but you can't do it all. So I think that self-awareness and knowing what is superpowers are.
As long as you've covered, you know that you'll be able to cover that gap in the future. I wanted to talk about something that's very close to my heart, which is India, in terms of Indian founders, and and I'll make a very quick point. We have a bunch of STPI companies, and we don't have enough time here, so we should do probably a separate panel. But the quick note I would make, based on my experience, and I've got lots of experience on that, if you're a consumer company for India, I used to say Shaadi.com, then remain in India. But if you're an enterprise AI, your customers are in the US or global, and I can just a nod of heads that you should probably be thinking about reincorporating US, have your IP here, and that's the best way to grow, right? And maybe you can say whether you'll invest in an India enterprise company with global service in global markets, or would you require them to be US? Sanjay is probably the only one with some sort of contradictory.
No, we've also changed. I mean, now, as we moved up, we've almost said the founder has to be close to your customer. Okay. And I think domicile, of course, makes it very helpful to be US domicile, but you have to be here because I think you're competing to build the best global product, not the best India origin product, right? So you have to be here. You have to be in front of your customer wherever it is, maybe in New York, or because it's close to pharma or biotech, but we've changed because
we don't have enough time for the specifics of that, and we should do a separate panel, but I just want to make...
He is right in the sense, if you are building a company in enterprise AI, you have to be in US. Within US, again, you are building a product, you should be in Silicon Valley, not in some Boston or in New York. If you want to do a company in New York, go in a financial fintech space or blockchain. You want to do an AI space, everybody's back to California, guys. Don't go to Austin, don't go to Texas. It's all come back. Make California great again. That's all matters to me. Right? And also the investors want to be close to the founders. So if I invest in a founder, I want to be in my driving distance. If that guy is in Central Valley, I'm not going to invest in him. Let him go to find a farmer in Silicon Valley as an investor. Right?
Sorry, go ahead.
Two of our portfolio companies, right, the founder, CEO moved to the Bay Area, and to be honest with you, the proof point is their revenues took off.
And they're sitting next to your house.
Close to. And because most of the customers are here, right?
All right. I know enough to know that I should not be in the way of the founders asking questions to VCs. So we have very little time, 20 minutes, but we'll start with the gentleman here. Yes.
We should get them a mic, please.
Yes. Do you have a mic, extra mic here?
The person at the back said he has a mic.
Why don't you just stand up and if you can loud enough ask that question, I can repeat it if needed.
The thing is, I've built the world's fastest growing tech startup within the shortest possible time at minimal cost, but I'm now in a very awkward position because it's like, the investors overseas here are talking about just investing from Indians, team in India, and I don't...
No. People in US. I don't invest just India and US. That's what I look for.
Right.
So can everyone just quickly say yes or no? I mean, would you invest in a non-Indian founder but in the Valley and obviously with great products?
Yes, we can.
Yes. Okay, there you
We
go.
have invested, yeah.
Thank you.
Okay, so if it's not India, but not yet US?
I invest in if the founder is in US or India, that's it.
Where are you? Let's talk about that. Where are you? What are you? Like,
Currently in Malaysia, but we're moving our...
but again, I would say, I'll quickly say that customers, right? Do you have customers? Do you have revenues? I mean, Muthu is absolutely right. Can you make money for the investors?
It's in Southeast Asia. Yeah.
I think they'll be very interested in talking to you, I would say, right? Maybe you can get some team in India. George has and all of them have very little sort of threshold. If you have a team in India or a co-founder or management, something connecting to India.
Yes.
As long as customers.
That's all we need. That's all we need.
There you go.
Right. We have invested in companies where there's no connection to India. We invested here in Bay Area. Yes.
Right, our IT manager is Indian.
Excellent.
I
The
think
gentleman in the back.
All right.
That was good. Hi, everyone. Abdel Ali from Kiwi Charge. Most of my co-founders are Indian, but we're a Canadian startup. We're in the robotics space. Any advice in terms of one of the benefits of Canada? There's a lot of non-dilutive funding, like grants, and we're recipients of $500,000 so far. But we're hearing the need to come to and incorporate in the U.S. Any advice for Canadian and foreign companies?
Become a 51st state. Then you let the VCs will invest.
You need a podcast. You're hilarious.
Don't give him ideas, please. Anybody else?
Yeah, I mean, I'm definitely dreaming about Modu tonight, but it's funny with Canada because there's a huge network here in the Bay Area. I don't know if you're part of C100 or
we're hoping to join. Yeah.
So it's similar to TIE, but for Canadians, right? And so networking and getting finding good resources there would get you a head start and maybe allow you to go a little bit faster. And certainly build upon the experience of many Canadian founders that have come here and been successful around fundraising. I think like everybody else implied before, and this goes to your question too, if the notion of an international founder who has operations back at home, but with the head office here, it's very familiar. It's a model that most people will invest in. And so it's, how are you approaching the US market? Your success at home may not necessarily translate into this market, so that's the jump that you need to make.
I'll just add a general point there. So I think there's three things. So there is, where is your target customer base that you're really focused on? Where is your incorporation? And where's your investor? Ideally, you want all three in the same geography. So to avoid friction, you can raise, if you're a Canadian company selling into Canada, there are companies that have raised here, just a higher bar, more friction. You have to find the right folks for it. So if you are targeting the US market, I'd say reincorporate as US, raise here, move to the Valley, and then you fall in that sort of more clear path. There are investors that invest in Canadian companies.
I would add a fourth point. Where is the likely exit? Are you likely to exit, sell to a large technology company in the US or go public in US? Sanjay is now also looking at some of these companies going public in India and potentially reincorporating. So item 4 on that.
He's absolutely right. I think you need to understand, you have to make money. If you want to make money and your exits are here, you move here, man. Don't be in Canada. Okay. That's it.
Seems like we have a long list of
Yes,
people. Let's maybe answer
minutes.
one answer for every question. Let's just do that.
Okay.
What do you think?
Let's do that, yes.
So my name is Alok, and Anil said no pitching. Your company, so I run an XYZ company. But
Alok is Brownridge, he's my client, so he will get to pitch.
But you did not say that I cannot show my T-shirt, so everybody can read.
That is true. Good pitching.
All right.
Let's move quickly because we have a lot of
No,
people.
absolutely. I went to temple this morning, so came with a different feeling, but Muddu is a bad influence. I'm carrying a burden of X. So many of the investors invested in EdTech before, education company. That's what I run, and I'm carrying that burden, right? Today, I'm about to hit 5 million ARR, and we are 5x more capital efficient in our vertical on the planet. You can compare us with anybody, and we just turn EBITDA positive. And my question is, how to overcome that X factor and convince our investor or sugar daddies that if you burn out before, it doesn't mean that you will keep burning out. I have all the numbers.
Go to family office. Education technology, people didn't make money. So find a family office. VCs will not come this space.
Yeah, you'll not be able to convince them. If they already don't have a thesis, you'll not be able to convince them. Save your cycles, go where you can get interest.
So I've been informed that these guys, I guess, have been volunteered to be part of the VC Connect, which is right next door after this, and they will make themselves available at the cost of lunch, I suppose, and answer specific questions you have on your business, maybe even pitch to them. So if you have general questions on pitching or fundraising, please use those. If you have specific questions on your venture, probably wait for the VC Connect.
Thank you.
Thanks.
Good luck.
Thanks, guys. I'll try to be quick. You guys gave checkpoints in terms of things that you should, criteria you should qualify before going to VCs. How would you adjust those checklists for startups that are hard tech, startups that require a lot of upfront money before going to market? Because a lot of your checklist was geared towards startups that can engage with customers right away. They don't need a lot of physical infrastructure to do that. Whereas hard tech like semis or when you're building physical things, you need the money up front and then later you get the customer, right? So how would you adjust your perspectives?
I can talk. I did my first company called Sanera, which is a hardware company. Mm-hmm. You need to have a background. Let's say if you're building a system, flip chip design, semiconductors, I will look at your background. My first check was actually Andy Bechtelsheim wrote check in 1999, and Ram Shriram, who sits on Google's board. So you need to go find people in that space, get them to write your first check, then go to VCs, because semis were not hard for 20 years. Now they're back again. So it all depends on, you don't need to be really, if you have a deep tech, find a person who believes you, get them to back you, then go to VCs. Yes, they will write checks. Right now, semiconductors is back again. But you have to find somebody who believes in you, who is well known in the industry.
George, would you invest in a semiconductor company that will obviously require hundreds and millions of dollars in investment in the future, but with a good team, and obviously you need to have the plan layout, or how much, have the financials, everything set out, right? And where's the money?
I
how
would
much
say
money
semiconductors because we
or infrastructure
outside of
overall.
it. But we have invested, and in fact, Andy's company SVB is kind of the banker. Is you have to get a way to have a bank, right? Facility to use for your initial capital, right? Along with your initial investment. That arrangement is what you need to have. And we invested in a company that exactly did that. Because their hardware costs more than $50,000.
Right.
We have a client that did that. They early stage startup raised really $2 million from friends and family, but they did a very good thing, which is partner with a South Korean company, which basically took over most of the cost of manufacturing, setting up their factory in Bangalore, right? So if you can find partners to defray that cost, investors would love that because you've obviously de-risked the overall capital requirements.
Okay. Just very quickly, we have a line, but hard tech is hard, but it's very interesting, and that's also a moat. So I think one of the points is if you can get customers to say, if you build this, what would it take to build it? Can they do options contracts or LOIs or things like that? But we've done robotics, we've done drones, we've done space tech. So VCs are interested, but you have to show some customer proof points, even if they don't pay you, but some linkage, even before you start.
Okay.
Yeah, I would add to that, and what Mithul said is true. Investors want cash, but they get even more excited with customers, right? Because they just don't want to be looking 5 years down and say, well, we were fools to invest. As long as you have customers, who knows where things go out? You make money, you don't make money, but they should check the box that you're the solid company with all these thoughts. And customers are actually even more important. Money will come, obviously, if you have the right plans.
And some of the CVCs, a lot of the hardware companies do have those as well.
Corporate VCs.
Corporate venture cap firms, and they will have both that combination of capital plus the ability to assess your idea and your
Great
technology.
point. Yeah. Strategic, yes.
Yeah.
Yes.
Thanks. I hate talking in front of people, so apologies. First of all, congratulations on all the amazing accomplishments you guys have made. I think it's incredible. We're in a growth phase as an organization, Indian founders, all in a very clear vertical SaaS B2B business, over 300 customers paying a penetration exceptional product market fit, really, really good. And we're now establishing a footprint here in the US, already have beta customers. In order to set up in the US and move from this growth phase and accelerate, do we need to establish a local entity, Delaware type organization in order for investment to be made in our business to grow?
I went through 2 examples. I was a CEO as well, right?
Thank you,
So
George.
if you are, most of your customer are going to be here,
yes,
or most of your revenues are going to be here,
correct,
are both, it's better to have a US entity.
Brilliant, thank you, and that is correct. That's the health.
Also, in some cases, the US customers will not give you the PO without a local entity.
Thank you.
Okay.
Thank you.
I have a question which has linkage to what you said at a point of a time when you said that TAMs sometimes come thin out of air and they just become big. So my TAM is not coming thin out of air, but the dilemma which I have been facing constantly is this, that how focused we go, because once we start increasing our focus and we narrow the focus, the TAM starts becoming smaller. And if you look at the TAM and want it to be bigger, then our focus starts becoming wider. So then there's always this trade-off in between how sharp we go when we define our market and accordingly customize our product, and how do we create that balance, and what's the right TAM which the investors will be really interested to look at?
That's a great question, and one of the investors
I can answer it very quickly. See, TAM needs to be always big. Doesn't matter if it's $1 billion, $10 billion. After a while, it doesn't matter. What you are getting confused is called serviceable addressable market, called SAM. So once you have the TAM, you may service only this much portion in 2025, this much in 26. So create TAM, both bottom up and top down. Create a SAM separately. This is what you will address this. So don't confuse these two. Okay, so TAM is TAM, SAM is SAM.
Muthu will be available after this for his consulting services, right? I mean, he obviously has
my lawyer, so I'll charge
great experience, real perspective. So I think, for any investor, I mean, that's a great question. I think the perspective of how do you dance
happy to add a little more color. You need clarity on both ends. You need this sharp early wedge, which has to be super specified, saying that this is specifically the product, this is how I'm going to sell, this is how much money I'm going to make, and maybe my first sprint of revenue is going to be this specific journey. But on the flip side of it, there's that kind of bigger vision, saying that, sure, our first product is X, where are we going? What market are we playing in? How big is that market? And potentially, if there is a path from your first product to maybe a family of products, maybe services, etc., we can also draw this chart, saying that today we are building, and I know you're building the state measure, which was pretty cool. I saw the demo. But like, if you can kind of chart that path, saying that today we are doing this, but in 10 years, we want to be at this other place. That is what is kind of the right balance, in my opinion, both in terms of that large vision, but also.
Can be how longer for us? Like, can we say that this 3-year journey for us is this, and then we'll start looking at a bigger TAM, or how we should? I mean,
just make it as big as you can. FOMO, scare the shit out of people. Put the biggest TAM. What you can.
Yeah, I think the answer Prateek is saying is that as long as you can get Prateek interested, and Prateek knowing that George will be interested, you've got a good deal, right?
That's right.
It can be 3 years, but it has to be like a meaningful number. If you say in 3 years, I'll get to $1 million revenue in the current market, that'll not be exciting. But if it's the same product, in 3 years, you get to $20 million of revenue. That might be.
And again, they're available after this for a specific one-on-one if you like, right? Excellent.
Thank you. Thanks a lot.
Good luck.
Hello. One of you probably mentioned that for AI company, a new business model could be outcome-based. Can somebody give an example of like what an outcome-based business model would be?
Okay.
Not cash, Muthu, not cash. Other outcome.
I can give an outcome. There's one of your portfolio companies, it's AI. So their outcome is based on how many calls get completed without getting to a human. Good example. Okay? That's completion rate without going to a human is how they get paid. Just to give you an example.
By the way, that won't work always in SaaS. You have subscription, consumption, outcome. Not all enterprise will be outcome-based, and it's variable. It may not work for you.
Right. Anyone else has any specific example?
Like an example would be in case of an IT, if you have a action you want to take, fix your laptop. If I don't fix it, I won't get paid, right? Yeah. Similarly, he talked about call centers, customer service. You call, I want to return my money back. If the call was not done by AI agent, I won't get paid. If it goes to a human, you won't get paid. So there's so many outcome-based models exist in that whole space in customer service, IT.
I see.
You have to take that out. Thanks.
So if I have a middleware product, which there is no outcome per se, I mean, basically it is enabling development of new AI applications, and our middleware sits in the middle for data access. So I can't.
Sorry, you can connect because we have a long list still and 5 minutes to go. So, and we would love to have more female founders ask these questions. Thank you. Thank you.
Hello, it's a pleasure to meet all of you. I'm a student, and one of the most important questions I have for all of you is it better to start a company that's focused on trends or innovation, or are both of those terms interconnected? Because in my opinion, when you start a company, obviously you want to do something you're passionate about combined with your specific skill sets, but you also need to understand what the market and what the customer's needs and wants. But from a VC perspective, I've noticed a lot of trends of them wanting to invest in like agentic AI, SaaS, compliance. Like these are all very hot topics. So what would the best advice be if you want to start a company right now, and if I were to start something right now?
So best companies are, they start focus on a specific solution for a specific customer for a problem that they're willing to pay for, right? And if you can marry that with the current trend, that's great. If it doesn't happen, that's secondary. And that's where the funding piece comes in. But if you're solving a real problem that people are willing to pay for, and it's a scalable business, venture capital will come. How fast it comes is questionable. The other way doesn't work. If you build something for just a trend and there's no revenue, it's no use. You can raise venture capital maybe, but then if you don't solve the problem well, it all sort of, house of cards sort of falls down, right? So I'd say see where the trend intersects with a problem that you know and understand and can get passionate about, that, hey, I can spend 10 years on solving this problem.
I disagree. I think you should find what the problem you want to solve, find the customer. The contrarian investment is what I look for. Like if you follow 10 trends and you're doing the same thing, you're me too for me. So I look for something problem you want to solve. How big is the problem? Who are the customers? Go for that. Don't just look at the trends.
Yeah, just quickly, we don't have the answers, right? And so we don't know what trends they are. But if there has to be some substantive proof in the sense that, let's say you have an idea, it could be fashion apparel, it could be anything, right? But you're seeing a trend that the market has not seen. That's exactly what VCs want to do before they do it. But there has to be some proof. There has to be some substance. There has to be something around it versus just a thought. But, a lot of VCs have thesis. I think it's great to have thesis. The danger of a thesis is you try and sometimes fix founders into a box. So we are prepared to be surprised. I mean, most of the innovations have come from out-of-the-box ideas, which are very surprised. But you have to bring some insight to it versus searching for something.
Yeah. Don't go. I want to share. Sorry, I want to share an example, and that will sort of hopefully help you think through it. I say VCs are sheep. They follow. And I'm sorry, but I mean, and FOMO, all of that good stuff. But here's an example: Snapchat. Right? I don't know if you know the story, but the first VC who had never invested in a Snapchat, you couldn't have imagined, invested because his daughter at St. Francis was using it, and she told her dad that, hey, everybody's using it, and my friends, all of my friends. So you can build your own trend, but the question is, how do you get there? If you pitch a Snapchat, assuming there was no Snapchat today, probably none of these would be interested. But if you pitch it as an app that already all college kids are using and there's potential ways to make money, they can then help you how to monetize, how to build it into a real business, right? So there are ways to build your trend or get to the VC's attention from ground up.
Okay, so customers are number one.
Always, yes.
Always. Thank you.
Hi, my name is Brijesh Datta, and thanks for the great session. I have a question regarding communicating what we are doing in the initial phase to the TAM. that we are approaching to investors. And my question was partially answered with one of the questions that was asked, but there is a little bit of different color. So I'm building for vertical AI space, which means there are multiple customer types as well as segments and revenue streams as well. Now, the approach that we have taken is the easier entry and most critical pain that we see, not necessarily be the largest segment defining a TAM. There's a large TAM, though, when we are solving for that space. And I'm wondering if you have a word or two to share as to how best we can communicate that to investors.
I think we made the comment earlier, vertical AI is, Timpa, it's a departmental or vertical AI. You could be an e-commerce company solving only their retail operations. So that's something you may work and focus on. If your platform can get to $1 billion revenue in the future, your serviceable market is only 100 million, that's okay. So look at it as a SAM and TAM long term. TAM is what the market opportunity is. SAM is what you can service today. You can be really laser focused on one operations and get there. So convey both.
Convey both. And even if there are multiple customer types that encapsulate the whole TAM.
We have to wrap up the session. There are other people waiting, jumping to Canyon. But I do want the last female founder to actually have that quick question, quick answer, so we can wrap up.
I'm Purbi. I'm founder of DeepSolve. I'm building something in the marketing space. So my question is, what is the right to win for a startup when you compare it with the large incumbents, because they have the data, they are scaling, and how shall I think about building this differentiation?
Think about what did DeepSeek do. They are actually distilling from OpenAI. You drink, I drink from you. So think of that model. So don't worry about the data. So you can build your models on top of Gemini, Llama 3, Llama 4. So think about a small company in China disrupted in January. So I don't think size and data matters. You come with a new algorithm, you can disrupt it.
But when I usually go to pitch, this is the first question which I am asked, that how can you differentiate in this market because you are in this space where you're competing with large incumbents, even if they're not building something similar to this right now, but they are your indirect competitors currently, right? So what is the right answer to it when you're pitching to the VC?
Differentiation and that is sustainable, at least for the near term, right? What it is, because you know what you're doing, that's the most important one. How are you different? It doesn't have to, I can give a lot of even examples. Salesforce is a big giant, right? Zoho came from somewhere. How? They had a clear differentiation and still they are successful, right? There are many examples I can give. You need to know your differentiation and whether it's sustainable. Of course, you'll get that question all the time. How are you different? But you have to get over it. Yeah.
We really have to wrap up after this, and they're available at the VC Connect. And also, there's been a question about sharing your contact information. I'm assuming they can go through. You can go through TIE, and they should be able to share the contact information for all of you. And I want to thank the panel for an excellent discussion.